The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
Hello, everyone. My name is Derek Doyle. I'm an associate advisor here at John Ullman Associates, the Rhinebeck branch. And in today's video, with the recent market volatility, I want to walk you through a recent blog that I wrote titled Markets versus Portfolios. So to start, to give some recent context, the S&P 500 has been on a historic run. The last 3 years have returned double-digit gains starting from 2023 through 2025. Last year alone, the index returned just over 17%. During these, what we like to call extended bull markets, investors often feel two conflicting emotions at once: the fear of missing out and the belief that this rally will never end. Both, however, emotions can be equally as damaging when we're facing individual investment decisions. So every year, Wall Street likes to give their outlook. The AI-driven trade is now entering its third consecutive year. Each year, financial institutions publish S&P 500 price targets, not as certainty to say that they have a crystal ball in their hands, but as a directional framework for letting the investor community know where they see the market going and what direction. These estimates factor in investor sentiment, macroeconomic data, the Federal Reserve, and White House policies. The broad market expectations don't always translate into your individual portfolio. The gap is exactly why understanding the difference between index performance and your personal portfolio does matter when investing and constructing a portfolio. So let's dive into the key differences between a portfolio and an index. A portfolio is intentionally built around an individual's specific goals. Those goals can be income, retirement, capital preservation, or aggressive growth. It accounts for risk tolerance, time horizon, and liquidity needs, and also your personal preferences. A market index, however, is a standardized benchmark designed to measure and compare, not specifically designed your own personal situation. But when investing in an index, it does give you broad economic exposure, but it doesn't account for your own unique risks and planning horizons. For investors seeking this broad market exposure, we can invest in an ETF like an S&P 500 ETF. This can give you what we like to call cheap beta. It's effectively tracking the market with high liquidity and minimal fees with no active management required. This works well for many investors who happen to be younger and longer time horizons. But it's also important to understand what's happening beneath the surface of these index funds. So what's actually inside the S&P 500? The S&P 500 is market cap weighted, meaning larger companies carry a greater influence on the overall performance. The top 10 companies alone make up over 40% of the index. So yes, technically you own 500 companies, but nearly half of your exposure is concentrated in just 10 stocks. There are 11 sectors that make up the S&P 500 index. Information technology, to name one of them, makes up roughly 1/3 of the index on its own. And then when you factor in communication services, nearly 50% of the index is now tied to US technology-related stocks. This level of concentration challenges the idea that the index is a true broad diversification investment. The largest US tech stocks, what the industry likes to call the Magnificent Seven, have driven the outsized returns over the last decade. And this has been especially true since the launch of ChatGPT in late 2022. This has led to the surge of the AI trade, like I had mentioned earlier. The Mag 7 is effectively in the driver's seat when it comes to the overall market performance, and it's critical to understand when evaluating how your portfolio might be positioned over the long run. So let's talk about the rise of passive investing. Passive investing strategies now account for nearly 60% of all the equity market flows. What is passive investing? Well, most stock purchases today are not made by active investors choosing individual companies. They're made by index funds, ETFs, and mutual funds automatically buying the same stocks that they already hold. Think of bi-weekly 401k contributions. They are automatically flowing into the same mutual funds and indexes on every payroll cycle. Because these indexes are cap weighted, larger companies receive disproportionately large shares of every new dollar that is invested. This is one key reason US technology stocks continue to grow faster than the rest of the sectors. So to kind of tie this all together and what it means for you, there's nothing inherently wrong with passive investing, but it's important to understand how it works and how it could fit into a tailored portfolio. As you approach retirement, your portfolio will often look very differently than it did during your working years. Retirement portfolios tend to be more strategic, blending assets, incorporating tax planning, and risk management that a broad index simply can't offer to you. Review your portfolio at least once a year and make sure that these still align with your financial goals. A qualified financial planner can help ensure that this portfolio stays optimized for you and your individual needs. Thank you guys for watching this video, and don't forget to follow JGUA on our various social media platforms.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.